Hello, everyone, and welcome to an all-new episode of OIC's Wide World of Options. I'm your host, Mark Benzaquen. This month, we're going to look at some of the factors investors typically consider before making a decision to buy or sell options, including a determined forecast for the stock and a clear objective for the trade, understanding profit and loss potentials, the impact of the Greeks, etc. And to help us make sense of these factors, I'm happy to welcome to the show Jessica Inskip, Director of Investor Research at stockbroker.com and host of Market Make Her podcast. Jessica, it's great to see you again and welcome to the show.
I'm happy to be here, Mark. Thank you so much for inviting me.
Well, you're very welcome. Jessica, let's start with this scenario. So we've got an investor new to investing in options. They're bullish on the stock. So that's our scenario. How
Mhm.
might that investor decide whether they want to buy calls, whether they want to sell puts, for example? What factors might they consider aside from that forecast? What factors might they consider when they make this investing decision process? So let's go ahead and start with objective. How does that come into play?
Yeah, I'm glad you said start with objective because I think options are such a wonderful and beautiful tool. They can really fit into any type of investment objective. So I would begin with there's an underlying security that's in play here. How do you feel about that underlying security? Because it is a derivative. Are you speculative? Do you feel like it's going to move up very far? By how much and by what time frame? That will help us understand if you are perhaps even a little short-term neutral to longer-term bullish or really believe there's going to be a large directional movement. And then I would go into why, and that would help formulate the strategies from there.
Right. And so, as you had mentioned, short-term bullish or short-term neutral, et cetera. One
Mhm.
of the things that I liked is, and it's something that I talk about a lot, is it's not just knowing or thinking where the stock's going to go, but also the time frame that it's going to that it's going to take to get there, and then also the magnitude of that increase. So, if you're, bullish, and you had mentioned leverage, or I'm sorry, you had mentioned speculation. Uh,
Mhm.
that's going to kind of determine one strategy. We're not going to be selling options if we're looking to speculate. Another objective, income generation. If we're looking to derive income from the premium that we receive, we're not going to be buying options. So that objective is really one of the key ingredients in making that decision, because that might put us on the trajectory already of whether we're looking to buy or sell, right?
I completely agree. And I think not to get abstract on you, Mark, but when we're making investment decisions, it's become very easy because of technology. We can place trades relatively quickly with just a couple of phone taps. Whereas if you're making an investment decision like buying a house, you still take a lot of time and considering to make sure that it's in the right location, that you can grow with it. That same type of time has to be applied. So I love what you're saying. And so to build on that, yes, we would choose if we want to be speculative. I know that I feel like this underlying security is going to go to a higher price for some reason. And therefore, since I'm speculative, I'd want to purchase a long call. I have defined risk in that scenario, but I also have unlimited profit potential. Whereas on the other side, if we want to capture premium, we could sell a put, create a short put, whether that's cash covered or has a margin requirement. There's other intricacies or complexities involved. But in this scenario, I'm neutral short term because the most that I can capture is that premium. And then bullish long term, because if it does move adversely, then you're obligated to buy the security. But there's lots of different ways that we could even utilize that strategy. So that's the beauty of options. But I always think it's important when we're talking, especially to people who are trading for the first time, to consider the investment objective. I love that you started with that.
Right. Yeah. Thank you. You had touched on maximum profit, maximum risk. Let's dive into that a little bit. So when we're buying options, you had mentioned that our maximum risk, right, is that which we put into it. We can't lose any more than we put into the trade. What about maximum profit?
Yeah. So when we're buying options or long calls, maximum profit is technically unlimited because when we have a long call, I actually love to separate the vocabulary. Long means purchased, call means the right to buy, short means sold, and then put the right to sell. So just always putting that together. So if I have a long call, I've purchased the right to buy. So I want my strike price, which is the price that we agreed on in that contract, to be much more favorable than what the market is. So I'm very bullish in that scenario, but will it go to a theoretically infinite price? We could decide what our limit is, maybe layer on technical analysis. We could add another layer to the strategy, if you will, to define that.
Yeah. All right. So let's get into that a little bit more. When you buy
Sure.
a call, as you had mentioned, gives you the right to buy the stock from your strike price to, regardless of how high that stock price goes. You
Right.
had mentioned to infinity, I think. Um,
Hmm.
the chances that the stock is going to go to infinity. If we have a more realistic expectation, and this is kind of going on a tangent, so I apologize, but if we have a more realistic expectation of where that stock might go, rather from 50 to 5,000, but more realistically, maybe 50 to 55 or 50 to 60, is there a way that we can reduce our risk and our cash outlay by doing something different? What might that look like?
Yeah. And as you know very well, Mark, that's called a bull call spread, where we essentially create an extension of that long call and we cap our profit potential because we have defined risk. We paid a premium. We paid a premium for the right to buy that security in a case of an equity option at any time through that expiration period. We're the driver in that scenario. But that means we are largely speculative. We expect a sharp direction upwards in our desired direction, and we expect that to be more than the premium paid. And therefore, to reduce that large speculation that we need, or that acceleration that we need, which is equivalent to the amount that we paid for that contract, we can reduce the amount that we paid by selling a further out of the money call that would cap our profit potential. Same expiration, extremely important in this type of strategy. But if we've got, for example, I buy a long call on an underlying security and I have the right to buy it at $100 per share through the next 30 days. If I feel that it's going to go to 120 and it's not going to go any higher, perhaps I see some sort of resistance or whatever your process might be to determine that price target. It could be fundamental. Just you have a process, you could sell a call at that stopping price and it would reduce the cost that you paid altogether. So, for example, if you paid five for that long call, and you received a premium of two for the short, just for example purposes. Now I've reduced my cost from five to three. I need the stock to move $3 rather than five less to break even and then start kicking in profit. But options, as you know, have a give and a take.
Right.
The give in this scenario is the reduction of cost, the reduction of that defined risk. The take is we're capping our upwards potential.
Yeah, exactly. You were talking about when we're buying options, uh, the break-even point, for example, right? If we're buying a call, it's going to be our strike price plus the premium that we paid. So we
Mm-hmm.
need for that stock to make a movement beyond that point, or we need, for example, implied volatility to increase that raises the value of our prices. Um, I guess not my question, but the point that I want to bring up is the reason that is because we've got these other factors as a buyer, these other factors working against us. The Greeks, for example. So how do the Greeks pertain to a buyer of an option? And then we'll, look at the flip side as a seller. But from a buyer standpoint, what are some of the Greeks that might impact our position and hopefully our profitability?
Oh, I love this question. As you know, Mark, I love the Greek so very much. uh, so I like to start with understanding an options premium, assign them a positive and negative value, and then we just give the Greeks their name
Okay.
because that's what I find is the best teaching method personally. That's my personal opinion. Um, so in a long call, the stock if the stock moves above your strike price, that's going to make the long call more valuable. That's a positive scenario for you. If the strike moves below, that's a negative scenario for you. If there is less time until expiration, that is a negative scenario for you because an option is comprised of intrinsic value and extrinsic value. Intrinsic is the the stock moving up or down in your desired direction, if it's in the money or not, those terms. And then the extrinsic are really external factors that are out of our control. We can't control time. It's always moving against us. And then there's anticipated movement. A great example is earnings. There is this anticipated movement in either direction, depending on how earnings are reported, positive or negative. And then forward looking guidance could even impact that. But either way, the market or market participants normally expect a move of some sort in either direction. A large move in magnitude is much more beneficial for long positions, regardless if it's a call or put. So that's more valuable. And the way I like to tie that together is that in a way explains delta, theta, vega, and gamma. So delta is something it helps us choose our strike prices. It's so much more versatile, but it does tell us direction as well. I like to say that delta is the destination. A stock that, or 100 shares of a stock is a delta of one, and one contract always represents 100 shares. So this is the destination for long options. You want it to have as much value as possible. The more that delta magnifies, the more valuable it is. But how do we get to that valuable area? Well, we need an acceleration. If that's our destination, what's the engine that gets us there? That's gamma. Gamma tells us the rate of change of delta. So it's really the difference of a higher gamma means you're in a Maserati on this journey to your delta of one in a case of a long call. Whereas if you have a smaller delta, you might be on a bicycle. And if we are expecting a strong directional move because we've defined our objective for the long call, we'd want a higher gamma. And gamma is usually centered around at the money options. So that helps us select. And it also shows you why something with a very, very small delta, which is very far out of the money, also has a smaller gamma because you've got a longer way to go. You're on a bicycle in terms of that journey. So that
I like
helps
that
you.
metaphor.
Thank you. But it helps you decide your strike price. That's what that does. And then to help us decide our expiration, we could consider theta. As you know, theta is not linear. Theta is the extrinsic value decay. It tells us the daily decay as the option nears expiration. And as it gets closer to expiration, that decay just accelerates. But
Mhm.
as an option holder, you have an option, pun completely intended, to you don't have to hold your option until expiration. So if you're buying theta, you can also sell it back. So that's important to consider and why it's prudent, in my personal opinion, to have price targets in mind or to consider the investment objective. And then, so theta is negative for long options. Gamma is positive for long options because a sharp directional move is good. Delta positive for bullish strategies because we want it to go up in value. And then Vega, this is where we're considering Vega and implied volatility. Volatility and implied volatility are two different things, but implied volatility makes our options more expensive. And so if I want exposure to something that's going to increase in implied volatility, so that's simply positive Vega. If I'm positive Vega, I'm going to benefit from an increase in implied volatility. So if I expect something to happen where maybe it's AI related or who knows, whatever your investment thesis is, then you would be benefiting from having a long option. But if you feel that implied volatility will collapse after an earnings event or something like that, then a long option may not make sense because it's already expensive. So I think the Greeks, they really help us, one, put together our investment objective. That's where we always start with options. But two, then we move into strategy selection. What strike price am I going to choose? What are the agreed upon price? We can look at delta, we can look at gamma, and what expiration am I going to choose? We could look at theta, understand that, and then strategy selection. Do I want to be positive or negative Vega? Do I expect an increase in implied volatility? Do I expect a decrease in implied volatility? Things like that. Long
Right.
answer.
And no, and I love the answer. Um, and all of those factors that you had mentioned help investors to decide whether or not they want to be a buyer or a seller, as you had mentioned. If we're thinking that there is a potential for a big run up in the price of the underlying, right, an increased demand for those options, that's going to affect implied volatility, as you had mentioned. That's going to affect Vega. We're going to want to be long Vega in those instances. And the way to do that is to buy options, again, whether it's a call or put. Time until expiration, hugely important. I always look at it as an option buyer needs something to happen in the market to change or actually to increase the value of that contract. And those changes would be a run up in the stock price or increased demand for the option. So therefore, increase in implied volatility. Uh, but the buyer needs something to happen to get from their strike price to their break even point and beyond. Flip
I
side of
agree.
Flip side of that is from the seller's perspective. The seller doesn't typically want anything to happen, nothing to change from where they are now. And the reason being is time decay, as you had mentioned, is going to erode the value of that option every day. If I sell something for $2, it would be ideal for me to be able to buy that contract back for anything less than $2. That's going to be where I derive that profit. So I like to look at buyers versus sellers as buyers need something to happen. Sellers don't want anything to happen. But getting back to the seller's perspective, we had talked about risk and reward for the buyer. What about risk and reward for the seller? How does that work?
Oh, well, it depends on the scenario. So if we want to go on continue on this bullish path, a short put, our maximum gain is that premium that we're receiving because, like you stated, the buyer wants the option to go up in value as much as possible. The
Right.
seller wants it to collapse. They don't want it to have any value. And I love the way that you stated something has to happen. I think that that's so beautifully put, and I will be borrowing that, Mark. But so the short put, so if you sell a short put, you hold a short put, you collect that premium. Your risk is now in this scenario the obligation amount. When you're selling a put, you are creating the obligation to buy the security at the agreed upon price at any time through the expiration period. So the risk is the if it does move adversely, which means that put is going to start having value because a put, so a short put, I sold the right to sell. If I sold the right to sell and my right to sell price that's contained within that contract becomes more valuable than the market, which happens when the market moves down, then my obligation kicks in, which is where I'd have to buy that underlying security at that strike price. And again, one contract represents 100 shares, but it is offset by the premium that I received. So then that becomes my break even is if it moves too far beyond the premium that I received. But on the other hand, this type of strategy is utilized to buy stocks to keep them for a longer term portfolio. But when that happens, you have a completely different strategy because you've magnified your deltas and so much more we could talk about there. But great question.
Right. So when it comes to, I guess to sum everything up, when we're buying options, the premium that we pay, that is the most that we can lose. When we're selling options, that premium that we collect is the most that we can receive in terms of profit. In
Yes.
For a buyer, the profit potential certainly depends on the strategy, could be unlimited. For a seller, the risk potential could be infinite. As you had mentioned, we selling a put, we're obligating ourselves to buy that stock at the strike price. Well, theoretically, that stock can go to zero. We still have to buy it at our strike price. So depending on the
Hmm.
strategy, depending on which side of the coin that we're on, buyers versus sellers, profit and loss is going to be determinant upon which avenue we pursue. So all great stuff. Really appreciate that. Looks like we've got a few minutes left, and I wanted to talk to you about something that I think is very interesting that you've been doing lately. You have a podcast called Market Maker. Would you mind telling us about that? What was your thinking, or what was the need that you saw in the industry for this type of target audience, for example?
Yeah, happily. And it's Market Make Her, HER. There's another one called Market Maker. So I always have to clarify that.
Thank you.
And thank you for asking that question. It was very interesting. There, as you know, there is a whole new generation that is becoming market participants, and it is amazing. And they like to consume their information very differently than previously before, and that's naturally because of the advances of technology, meaning short
And
form video
by
content.
right, by previously before, you mean for old people like
Or even myself, that wasn't around when I was learning. There was no TikTok that I could even scroll through. Um, Nonetheless, so I actually have worked in finance for 15 years, took a completely different career change so I could show up for the next generation. Part of that did require me to forfeit some of my licenses, but which has worked out very fine for me. But that was a risk that I personally had to take. But I teach my friend Jessie how the stock market works. We haven't gotten into options yet. A lot of our listeners really want that content, but it's a self-directed investing type of perspective, but very out of the box analogies. And even though it's called Market Make Her, one would assume that that is geared towards women, which it was initially. We say it's from her perspective. So we do use very fun analogies like how the business cycle relates to a menstrual cycle because a menstrual cycle is complex and it changes as you grow. A business cycle is also complex and changes as the economy grows.
I love that.
There's two phases. It's actually a really great analogy. But lots of things like that, where when I was personally working on the active trader desk, I was the first female there in my location, and there was 50 men. It was great. That's where I learned options really well, but they always used football analogies. And it made it more confusing just for me personally because I don't know much about football. Uh, so the podcast is essentially that. I teach my friend. It's very structured, and it's just so beautiful to see her put the market together and these light bulb moments. Our most recent episode, we're going in this deep dive of what actually caused inflation to begin with, because now, since it's been 5 years since COVID, we can access studies. So it's really, really interesting to view that. And then we're going to go through what the FOMC did in that scenario, because the word transitory is coming up. So we need to define it. And the best way to do that is with history. Then we'll revisit the Volcker era. So we've got a really good Fed series going right now because it's relevant within the market. But that's what we do is I teach her how the stock market works, and she'll bring questions that she sees from her account. We'll even bring up different brokerage firms and go through the buttons to click. But it's been really great, and we're a top 50 Apple podcast right now, actually. So
Excellent. That's
I love
terrific.
it.
Great news.
Yeah,
Congratulations.
thank
And
you.
it's a great segment. Certainly I've caught a couple episodes. I think it is very entertaining. I did catch the business cycle versus menstrual
Did
cycle
you?
before. That, definitely opened my eyes. I thought it was an interesting way to look at it, but really great stuff. Absolutely love it. Thank you, Jessica, so much for sharing that with us and for joining us today. Really appreciate you taking the time to sit down with us here at Wide World of Options. So thank you for that.
Absolutely. Thank you so much for having me, Mark. It was a pleasure.